America's debt has crossed $37 trillion, growing by $6 billion every single day. For decades, it seemed like just another number. Now, the interest alone could soon eclipse what the nation spends on its military. Why is the world's most powerful economy racing towards a breaking point? And what really triggered the debt that will end America? The story begins long before most of us realized something was wrong. In August 1971, President Nixon addressed the nation with a decision that would reshape the world's financial order. The United States would no longer exchange dollars for gold. This single act untethered the dollar from any fixed value, granting Congress and the Treasury a new kind of freedom and risk. The gold standard had forced discipline. Without it, the government could issue debt and print money without the constraint of gold reserves. In the years that followed, Washington tested these new limits. By the early 1980s, a new era of borrowing began to take hold. President Reagan entered office promising to restore American strength, cutting taxes sharply while ramping up defense spending. The result? Annual deficits soared. Federal debt, which had hovered around 35% of GDP through the 1970s, began a steady climb. Congressional Budget Office records show that by 1989, debt as a share of the economy had breached 50% for the first time since the aftermath of World War II. This was not the result of a single emergency or war, but a deliberate choice to spend more than the government collected, year after year. Economists and lawmakers debated the wisdom of this new approach. Some saw it as necessary to fuel growth and national security. Others warned that the habit of borrowing to cover shortfalls would be hard to break. Behind the scenes, the Congressional Budget Office tracked the numbers. Charts from the era show the debt curve bending upward, slowly at first, then with more urgency as the 1980s drew to a close. The gold window was gone, and with it, the last real barrier to unlimited debt. The baseline had shifted. The United States had entered an age where borrowing was not just a tool for crisis, but a permanent feature of fiscal policy. The stage was set for every shock that would follow. The financial crisis of 2008 delivered a shock that would define a generation of American debt. As Wall Street banks teetered and credit markets froze, Congress authorized the Troubled Asset Relief Program, TARP, injecting $700 billion into the financial system. Additional stimulus packages and emergency lending soon pushed the federal response to nearly $2 trillion. This was not a gradual climb, but a sudden leap. The Congressional Budget Office's charts from the period show the debt curve jolting upward, a permanent notch in the nation's fiscal record. But the 2008 bailout, as enormous as it seemed, would be eclipsed just over a decade later. In early 2020, a novel coronavirus swept across the globe, shuttering businesses and sending unemployment soaring. Lawmakers responded with a scale and speed never seen before. 4 major relief bills, including the CARES Act, unleashed over $6 trillion in government spending across 2 years. Direct payments landed in millions of bank accounts. Businesses tapped into hundreds of billions through the Paycheck Protection Program. Unemployment benefits were expanded, and state budgets were backstopped with federal cash. Every dollar spent was borrowed. The result was a debt surge without precedent in peacetime. In just 24 months, the federal debt grew by an amount equal to nearly a quarter of the entire U.S. economy. The CBO's data for 2021 and 2022 reveal a vertical spike on the national debt chart, dwarfing even the aftermath of World War II. Fraud and waste followed the money. Government auditors later estimated that $100 to $200 billion in pandemic aid may never be recovered. By the time the immediate crisis faded, the baseline for federal borrowing had shifted again. The government's response to economic shocks was now measured in trillions, not billions. Debt accumulation was no longer the exception. It had become the rule. The stockpile of obligations from these twin crises set the stage for a new fiscal reality, one where the cost of carrying debt would soon rival the nation's core priorities. Federal spending once followed a familiar pattern: Social Security, Medicare, defense. These were the pillars of the budget. But in the latest fiscal year, a new line item has surged to the top. Net interest on the national debt now stands at nearly $1.2 trillion, surpassing what the United States spends on its entire military. The Department of Defense, long the largest discretionary expense, will receive less than the government pays just to service its existing loans. The official budget table tells the story with cold precision. Social Security and Medicare remain the largest programs, but interest has quietly climbed to claim the third spot, overtaking defense for the first time in history. 13% of every federal dollar now goes to bondholders, banks, pension funds, foreign governments, simply to keep the debt afloat. This is not a temporary spike or a crisis response. It's the direct result of years of borrowing layered on top of rising interest rates. The Congressional Budget Office projects that if rates rise by even 1 percentage point, annual interest costs could jump by another $350 billion. With more than a quarter of the debt needing to be refinanced each year, the impact of higher rates hits the budget almost immediately. The scale is hard to grasp. Interest payments now outpace federal spending on veterans, education, transportation, and the environment combined. The government's ability to fund new priorities, respond to emergencies, or invest in the future is increasingly constrained by the cost of its past. The budget table is no longer a ledger of national ambition, but a record of obligations that cannot be escaped. Every dollar the U.S. government borrows today comes with a timer. Roughly 1/4 of all marketable Treasury debt, about $9 trillion, will mature and need to be refinanced within the next 12 months. The average maturity of America's debt is just over 6 years, far shorter than most of its economic peers. This structure means that when interest rates rise, the impact is felt almost immediately. According to the Congressional Budget Office, a single percentage point increase in average borrowing costs adds around $350 billion in annual interest payments, more than the entire budget of the Department of Agriculture. And with debt now exceeding $37 trillion, even small changes in rates ripple through the federal budget with staggering speed. Other advanced economies have built in more protection. In the United Kingdom, for example, the average maturity of government debt is nearly 15 years, with only about 10% coming due in any given year. France and Japan also favor longer-term bonds, reducing their exposure to sudden rate shocks. Japan's debt load is more than double the size of its economy, but most of it is held domestically at ultra-low interest rates, and only a small fraction matures each year. The United States, by contrast, has chosen to keep its debt short. This strategy saved money when rates were near zero, but it has left the federal budget exposed now that borrowing costs have climbed. The result is a fiscal system that reacts to market moves with little delay. When rates tick up, the Treasury must pay more, immediately and at scale. No other major economy faces this level of rate sensitivity. The math is simple. Higher rates feed directly into higher interest costs, which then squeeze every other part of the federal budget. In recent years, the full weight of America's debt has collided with a fragile political system. Congress now faces the debt ceiling as a recurring crisis, not a routine vote. The 2011 standoff triggered the first ever credit rating downgrade for the United States. In June 2023, the Treasury's cash balance dipped to dangerous lows as lawmakers argued over spending caps and work requirements. Only a last-minute compromise, hammered out behind closed doors, kept the government from missing payments. But each time, the solution has been temporary. Another short extension, another round of extraordinary measures. Inside the Treasury, contingency plans have become more detailed and more urgent. Memos circulated between the Secretary's office and congressional leaders outline how payments would be sequenced if the ceiling were breached. Interest on Treasury bonds first, Social Security and military pay next, and everything else delayed. Yet the official position remains that true payment prioritization is unworkable. The government's accounting systems were never built to pick winners and losers among millions of daily obligations. Legal reviews from the Government Accountability Office warn that any attempt to do so risks violating appropriations law and could trigger a technical default even if bondholders are paid. The result is a system where the threat of default is no longer theoretical. Each impasse injects fresh anxiety into financial markets. T-bill yields spike, credit default swap prices rise, and investors begin to question the reliability of the world's safest asset. The struggle between Congress and the Treasury is now a source of operational risk, one that could, with a single miscalculation or delay, push the U.S. into uncharted territory. Foreign governments have long played a silent but decisive role in America's borrowing. Central banks in China, Japan, and the Gulf states once held nearly $7.5 trillion in U.S. treasuries. But since 2022, that figure has dropped to $6.3 trillion, a decline tracked month after month in the Treasury International Capital data. The world's largest creditors are not making speeches. They are quietly voting with their portfolios. In mid-2024, China discreetly sold over $100 billion in treasuries, a move detected only later as inventory spiked on New York dealer balance sheets. Saudi Arabia, too, has trimmed its holdings, while headlines warn of a broader shift. More reserves are being parked in euros, gold, or even Chinese yuan. This retreat is not happening in a vacuum. As foreign demand softens, the Treasury must find new buyers, often at higher yields. The result is greater volatility in bond markets and a rising term premium, the extra reward investors demand for holding U.S. debt. Market unease is now visible on every auction day. Yields jump and the cost of borrowing climbs further. At the same time, inflation remains stubborn. Consumer prices are rising at an annual rate of 3.9%, even after the Federal Reserve's most aggressive tightening cycle in decades. Higher rates were supposed to cool demand and tame prices, but the effect has been slow to materialize. With every uptick in inflation, the real value of Treasury payments erodes, making U.S. debt less attractive to global investors. The cycle feeds on itself. Less foreign demand pushes rates higher, which swells interest costs, which in turn injects more money into the economy, fueling the very inflation policymakers are trying to control. Foreign officials rarely explain their exits, but every dollar they pull from the Treasury market is a quiet referendum on America's fiscal trajectory. As the world's largest creditors step back, the question is no longer whether the U.S. can borrow, but at what price and for how much longer. Warnings from global institutions have grown sharper. The International Monetary Fund, in its 2025 World Economic Outlook, described the United States as being on an unsustainable fiscal path, cautioning that persistent deficits and mounting debt now threaten to spill over into global markets. For decades, the dollar's role as the world's reserve currency offered America a unique shield. Central banks from Asia to the Middle East accumulated trillions in U.S. treasuries, anchoring the dollar's dominance in trade and finance. But that foundation is beginning to crack. The headlines tell the story. In April, China and Saudi Arabia finalized a deal to settle oil trades in yuan, bypassing the dollar for the first time in their bilateral history. The BRICS bloc, Brazil, Russia, India, China, and South Africa, has accelerated plans to use local currencies for cross-border payments. Central banks from the Gulf to Southeast Asia have trimmed dollar reserves, shifting assets into gold, euros, and renminbi. These are not symbolic gestures. They are deliberate moves to reduce vulnerability to U.S. fiscal and political shocks. Behind closed doors, IMF and Bank for International Settlement stress tests have modeled the fallout from a sudden loss of confidence in U.S. debt. The results point to higher global borrowing costs, capital flight from emerging markets, and a scramble for alternatives to the dollar. In public, officials speak in measured tones. IMF Deputy Managing Director Geeta Gopinath warned at a spring press briefing that investor confidence depends on credible deficit reduction. Privately, policy circles debate how much longer the world will accept the dollar's privilege if the U.S. cannot control its own finances. As the headlines shift from safe haven to fiscal risk, the world is no longer waiting for Washington to act. The erosion of trust in the dollar is visible in every new trade deal settled in UN, every central bank gold purchase, and every IMF report that questions America's fiscal credibility. The debt crisis is no longer contained within U.S. borders. It has become a global story, one that is rewriting the rules of international finance. America now stands at a crossroads with 4 distinct paths stretching into the next decade. Each is grounded in data, each carries its own risks, and none offers an easy escape from the debt spiral. The first path is fiscal consolidation. To stabilize the debt, policymakers would need to deliver a primary budget surplus, meaning revenues exceed all spending except interest, of at least 1 to 2% of GDP. That translates to hundreds of billions in spending cuts or tax hikes each year, a level of discipline not seen since the 1990s. The Congressional Budget Office calculates that even with aggressive measures, the adjustment would likely slow growth and push up unemployment in the short term. Yet without it, the debt-to-GDP ratio will keep climbing. The second path is roll-forward financing, simply borrowing to cover every shortfall. This is the status quo, but the math is changing, with interest rates hovering near 4.5%. and more than a quarter of the debt rolling over each year. Interest payments could breach 25% of all federal revenue by 2028. That's the threshold the International Monetary Fund warns can trigger fiscal distress, as new borrowing crowds out private investment and puts upward pressure on rates. A third scenario is diversification shock. If foreign investors accelerate their retreat from treasuries, yields could spike by 200 basis points or more. The result would be an extra $600 billion in annual interest costs once the higher rates work through the debt stock. Treasury auctions would become more volatile and the government would face a choice: pay higher rates or cut spending elsewhere. In this scenario, the interest-to-revenue ratio could approach 30%, a level that credit agencies flag as a warning sign for sovereign risk. The final path is default or restructuring. If political paralysis blocks new borrowing, the Treasury would be forced to sequence payments, prioritizing bondholders and delaying obligations like Social Security or military pay. Internal memos suggest payment delays could begin within weeks of a missed debt ceiling, with cascading effects across the economy. While outright default remains unlikely, even the threat of delayed payments could send shockwaves through global markets. Each path carries profound consequences, not just for Washington, but for every American household and for the global financial system. The choices made in the next few years will shape the country's economic future and determine whether the debt remains manageable or becomes the crisis that defines a generation. In August 2025, the U.S. national debt surpassed $37 trillion, with annual interest payments crossing $1.2 trillion, more than the defense budget for the first time in history. Decades of policy, from leaving the gold standard in 1971 to crisis-era bailouts to the unprecedented $6 trillion COVID response, have built a debt load that now shapes every federal decision. The documentary has shown how foreign governments have reduced their treasury holdings by over $1.2 trillion since 2022, and how inflation has remained above 3.5% despite repeated rate hikes. But some questions remain. The full impact of ongoing political gridlock and the true limits of global confidence in the dollar are still uncertain. According to the Congressional Budget Office and the International Monetary Fund, America's fiscal path is unsustainable without major change. The evidence is clear. The debt is no longer a distant problem. It is the central test for the nation's future, and its outcome is now being written in real time.